63-year-old man walks into a Walmart, not to shop, to work. He's wearing the blue vest. He's a greeter. 30 years ago, he was a middle manager at a Fortune 500 company. He had a pension. Then the pension disappeared. He had a 401k. Then 2008 cut it in half. Now he's here, standing by the automatic doors, saying hello to people who could have been his employees, making $14 an hour because his retirement account has $22,000 in it, and Social Security pays him $1,800 a month after Medicare takes its cut. This isn't a Reddit horror story. According to the Federal Reserve, this is the median boomer. 43% of Americans aged 55 to 64 have literally nothing saved for retirement. Zero. And the ones who did save? The median balance is $22,000. Under the 4% rule, that's $670 a month. Add Social Security, subtract healthcare, and you're looking at living on $2,300 a month in an economy where a one-bedroom apartment costs more than that in most cities. Here's what I'm going to show you. Boomers didn't fail at retirement because they were lazy or stupid or bought too many lattes. They failed because they were the first generation forced to play a game where the rules changed every 10 years, and the people writing the new rules had every incentive to make sure boomers lost. I'm talking policy shifts, corporate cost cutting, to massive market crashes timed almost perfectly to destroy wealth at retirement age and a financial system that was literally invented as they entered the workforce. This is a story about incentives, about what happens when you're the guinea pig generation for an experiment called do-it-yourself retirement. So let me set up the central metaphor that's going to carry us through this. Imagine retirement like a board game. But here's the twist. You start playing with one set of rules. Then halfway through, someone swaps out the rule book. You adjust. You figure it out. Then, right when you're about to win, they flip the board. Twice. That's the boomer retirement experience in a nutshell. And if you think you're immune because you're younger and smarter, I've got news for you. You're playing the same game. The board's just not flipped yet. Let me take you back to when the original rulebook was written. Retirement as a concept is newer than the microwave oven. For most of human history, you worked until you died. That was it. The first private pension showed up in 1875. American Express, back when they were a freight company, offered managers a deal. Work here 20 years, retire at 60 with half your salary. Notice who that was for. Managers, executives, not regular workers. Retirement for the masses didn't exist until 1935, when FDR signed Social Security into law. That's 90 years ago. The first Social Security check got mailed out in 1940. Boomers, the oldest of them, were born in 1946. They arrived exactly 11 years after the retirement game was invented. Their parents were the first generation to actually retire. Pension from the company, Social Security from the government, gold watch at 65, done. That was the rule book boomers grew up watching. Work hard, stay loyal to one company, retire comfortably, simple. Except by the time boomers entered the workforce in the mid-60s, that rule book was already being rewritten and nobody told them. In 1966, the oldest boomers turned 20. They got their first real jobs. And here's what didn't exist yet. The 401k, not invented until 1978. Index funds, 1976. Roth IRA, 1997. If you wanted to invest in 1966, you had to call a stockbroker on a landline, pay massive fees, and pick individual stocks without a computer, without Google, without any of the tools we take for granted. It was intimidating as hell, so most people didn't do it. The only system boomers had was their parents' system. Get a job, get a pension, pay into Social Security, retire. But in 1963, a car company called Studebaker shut down a plant in Indiana, and thousands of workers lost their pensions overnight. Just gone. Decades of work evaporated. That was the first time Americans realized the promise could be broken. And companies noticed something interesting. Pensions were expensive, really expensive. What if there was a cheaper way? This is where the incentives start to show up. Companies don't exist to make you comfortable in retirement. They exist to maximize profit. Pensions are a liability on the balance sheet. Every year, you have to fund them. You have to manage them. If the stock market crashes or people live longer than expected, you're on the hook. So corporations started looking for an exit. They found it in 1978, buried in the tax code, Section 401, subsection K. It was originally meant to let executives defer taxes on bonuses, but a benefits consultant named Ted Benna saw it and realized you could use it for everyone. Here's the genius of the 401k from a corporate perspective. It shifts the risk from the employer to the employee. You fund it, you manage it, you pick the investments. If the market crashes, that's your problem. The company just matches a few percent and calls it generous. By the mid-80s, pensions were dying fast, and 401ks were taking over. The game board had been swapped. Boomers were now in their 30s and 40s, and the retirement system they thought they'd use was gone. But even if they'd understood the new rules immediately, there's a massive problem. The stock market, from 1966 to 1982, went absolutely nowhere. 16 years, flat. If you invested $1,000 in 1966 and held it until 1982, after inflation, you'd have about $500. You lost half your money by following the advice we give today, which is buy and hold for the long term. Imagine that. You're 20 years old. Everyone older than you is skeptical of the stock market because they remember the Great Depression. You decide to be smart and invest anyway. And for 16 years, you watch your money slowly evaporate. In 1979, Businessweek ran a cover story titled "The Death of Equities." The thesis was simple. Stocks are done. They're a bad investment. For an entire generation, that was their first impression of the market. Not a wealth building tool, a scam. And that impression shaped everything that followed. Because unlike my generation, which has only seen the market go up our entire adult lives, boomers saw stagnation first. They learned not to trust it. Now you might be thinking, okay, but they had 16 years to figure it out. Why didn't they just start investing in the 80s when the market finally recovered? Fair question. Here's the thing. By the time the market turned around in 1982, the oldest boomers were 36. They'd already missed the most powerful wealth-building years. The early 20s, the time when compound interest does the heavy lifting. If you invest $10,000 at age 22 and it grows at 7%, by 65, you'll have about $213,000. If you start at 36 with the same 10,000, you'll end up with 76,000. You lose $137,000 just by waiting 14 years. Boomers didn't wait because they were lazy. They waited because the market betrayed them first. And by the time they were ready to trust it again, they'd already lost the compounding window. That's the first escalation. The rules changed and time got stolen. Here's where it gets really interesting. In the 80s and 90s, the market went on the longest bull run in history. From 1982 to 2000, the Dow went from 800 to 11,000. Suddenly, investing looked like free money. CNBC launched. Mutual fund ads were everywhere. You started hearing stories about 401k millionaires, regular people who maxed out their contributions from the start and rode the wave to 7 figures. It was proof, finally, that the system worked. So boomers, now in their 40s and 50s, jumped in. And because they were behind, they went aggressive. Tech stocks, growth stocks, high-risk plays to catch up. By 2000, they finally believed. They finally trusted the system. They thought they'd crack the code. The market always goes up. Put your money in and wait. Retirement was finally within reach. And then the board flipped. March 2000, the dot-com bubble burst. The NASDAQ lost 78% of its value over 2 years. The Dow dropped 38%. If you were a 54-year-old boomer in 2000 with $300,000 in your 401k, you woke up one day with $186,000, $114,000 just gone. And it wasn't because you did anything wrong. It was because a bunch of companies with no business model got overvalued and reality caught up. Now, to be fair, if you held on, the market recovered. By 2007, it was back to where it was in 2000. But here's the cruel part. Just as it recovered, just as boomers thought they were safe, the board flipped again. 2008, the Great Recession. Housing market collapsed, stock market cut in half, unemployment spiked to 10%. The oldest boomers were 62, retirement age. Their 401ks, which had just recovered from the last crash, got destroyed again. And this time, they didn't have time to wait for another recovery. They were too old. Let me give you a concrete example with real numbers. Meet Gary. He's not real, but his numbers are based on median data. Gary turned 22 in 1968. He got a job at a manufacturing company, started at $30,000 a year, which was decent. He watched the market do nothing for 16 years, so he didn't invest. In 1984, at age 38, the company switched from a pension to a 401k. Gary started contributing 5% of his salary. The company matched 3%. By 2000, Gary was 54. He had about $280,000 saved. Not bad. Then the dot-com crash hit. His account dropped to $170,000. He panicked, but his advisor told him to hold. By 2007, he was back to $290,000. Then 2008 happened. His account fell to $150,000. Gary was 62. He couldn't wait another 7 years for a recovery. He needed the money. So he retired with $150,000, which generates about $6,000 a year. Add Social Security, and he's living on about $32,000 a year. That's poverty for a guy who worked for 40 years and did everything he was told. Here's the second escalation. Boomers finally trusted the system right before it betrayed them. Twice. Now, let me hit you with a psychological angle, because this is where it gets dark. There's a concept in investing called sequence of returns risk. It's the idea that the order in which you experience market returns matters more than the average return. If you get bad returns early in retirement, when you're withdrawing money, you're screwed. Even if the market recovers later, you've already sold shares at a loss to cover expenses, and you can't get them back. Boomers hit retirement age during the worst possible sequence. 2 crashes in 8 years, right when they needed stability. And here's the thing. It's not like they could just keep working. A lot of them tried. But companies don't want to hire 65-year-olds. Age discrimination is illegal on paper. But in practice, if you're over 60, you're getting pushed out of corporate jobs and into low-wage service work. Walmart, Target, Home Depot. That's where boomers ended up. Not because they wanted to work there, but because nobody else would hire them. Since 1985, the share of Americans over 65 still working has doubled from 10.8% to 20.2%. That's not because they love their jobs. It's because they're broke. I'm going to do something here that might sound like a defense of boomers. And I know that's unpopular, but hear me out. The narrative that boomers had it easy is mostly true for housing and education. College was cheap. Houses were affordable. But for retirement, they got screwed. They were the test generation for a system that didn't exist when they started working. They were told to trust pensions, then the pensions disappeared. They were told to trust the market, then it stagnated for 16 years. They finally trusted it, and it crashed. Twice. At the worst possible time. The third escalation is this. The system was designed to transfer risk from corporations to individuals. And boomers were the first ones to find out what that risk actually felt like. Let me tell you a story that illustrates the incentive problem perfectly. In the 70s, Congress passed ERISA, the Employee Retirement Income Security Act. It was supposed to protect pensions, make them safer. But what it actually did was make them more expensive to maintain. Companies had to fund them more conservatively, hire actuaries, file paperwork. It was a regulatory burden. So what happened? Companies use ERISA as an excuse to kill pensions and switch to 401ks. The law designed to protect workers ended up destroying the thing it was supposed to protect. That's not a conspiracy. That's just incentives. Corporations will always optimize for profit. If a regulation makes something expensive, they'll find a cheaper alternative. Boomers were collateral damage. And here's the kicker. The 401k wasn't designed to be the primary retirement vehicle. It was supposed to be supplemental, a little extra on top of your pension and Social Security, but it became the entire system by accident. Ted Benna, the guy who popularized it, has said in interviews that he never intended for it to replace pensions. But once companies realized they could save money, there was no going back. The incentive was too strong. Now, the fourth escalation. Boomers are now between 61 and 79. They're all at retirement age. And a huge percentage of them are in a nightmare scenario. Too old to get hired for real jobs. Too broke to actually retire. Social Security pays an average of $1,800 a month. Medicare doesn't cover everything. Rent is $1,500 minimum in most places. The math doesn't work, so they're driving Ubers. They're working part-time at Starbucks. They're living with their kids. And a lot of them are bitter because they did what they were told. They worked hard. They saved what they could. And the system failed them anyway. Here's the uncomfortable truth. The same system that failed boomers is the system we're using. You've got a 401k or an IRA. You're investing in index funds. You're betting that the market will go up for the next 30 years. And maybe it will, but maybe it won't. Maybe we'll hit a decade of stagnation. Maybe there'll be another crash right when you turn 60. You don't know. Nobody knows. The only difference between you and boomers is timing. They got unlucky. You haven't yet. I've spent 10 years running my own business. I've sat in rooms with accountants and fiscal lawyers who manage hundreds of millions of dollars. And the thing they all say, the thing nobody wants to hear, is that retirement is a bet. You're betting that the market will cooperate, that you won't get sick, that inflation won't eat your savings, that the government won't change the rules again. It's not a guarantee. It's a probability game. And boomers lost. Let me give you the 2 comedic cutaways I promised, because this is getting heavy. First one. Imagine being a boomer in 1999, watching your 401k double in 2 years, telling your friends at the barbecue, yeah, I'm basically a genius investor. And then 12 months later, you're down 40%, and your wife is asking why you didn't sell. That's the vibe. Second one, picture this. You're 63. You're training your 24-year-old replacement at work. He's making $60,000. You were making $90,000. He's got his whole career ahead. You've got a Walmart vest and a name tag. He asks what you did before this. You say, I managed a team of 30 people. He says, cool. Do you know where the carts are? That's where we are. Now, let's bring it back to the hook. The real reason boomers are retiring broke isn't because they were bad with money. It's because they were the first generation to navigate a system that was designed to benefit corporations, not workers. Pensions were expensive. 401ks were cheap. The market was volatile. The timing was brutal. And the people writing the rules had no incentive to make sure boomers succeeded. This isn't about personal responsibility. It's about systems and incentives. And if you don't understand that, you're going to make the same mistakes. So here are my 3 takeaways. First, stop assuming the system will work just because it's working now. The 401k is 46 years old. It's barely older than Gen X. We have no idea if it'll work for millennials or Gen Z. The rules can change. The market can stagnate. Plan for that. Don't just assume 30 years of 7% returns. Second, diversify your retirement strategy. Don't put everything in the market. Real estate, businesses, skills that generate income. The boomers who are okay right now are the ones who own property or had side income. The ones who went all in on 401ks are the ones struggling. Spread your risk. Third, don't wait until 65 to live. This is the one that hits hardest. Boomers delayed gratification their whole lives. They saved, they sacrificed, and a lot of them never made it to retirement. Or they made it and they're too old and sick to enjoy it. Build wealth? Yes. Invest? Absolutely. But don't forget, you could get hit by a bus at 50. Don't postpone life for retirement that might not come. Lazy investing built more fortune than crypto memes, but it didn't build happiness. The boomer retirement crisis is a warning. The system doesn't care about you. It cares about efficiency and profit. Your 401k is cheaper for your employer than a pension. That's why it exists. The market doesn't care if you retire at the wrong time. Sequence of returns risk is real. And the government doesn't care if Social Security isn't enough. They'll just raise the retirement age again. You're not immune, you're just earlier in the game. The board hasn't flipped yet, but it will. And when it does, you'll understand exactly how boomers feel right now.